Section 23, Trust Account Records, Arizona Commissioner's Standards, Requirements for Licensees. Introduction, the math that must always work. Jessica thought she understood trust accounts. Deposit the money, track it, don't mix it. Simple enough. But then her broker showed her something that changed everything. A trust account ledger, lines of numbers, dates, names, balances, and one rule that could never be broken. Everything must balance, at all times. This section is where trust account handling becomes real. It's not just about where money goes, it's about how it's tracked, verified, and proven accurate every single day. What trust account records must always show. Trust account records must clearly show 4 key things at all times: when money came into the account, how much was received, who the money belongs to, and when and to whom it was dispersed. This means every dollar in the account must be traceable. For example, if Jessica deposits $1,000 in earnest money, the record must show the exact date it was received, the amount, the client it belongs to, and eventually where that money was sent. Another example is multiple transactions happening at the same time. Each client's funds must be tracked separately, even though they are all in the same account. Jessica realized that a trust account is not just one balance. It's a collection of individual client balances all tracked within one system. 2 places, one system, checkbook and client ledger. Every trust account transaction is recorded in 2 places, the checkbook or receipts and disbursements journal, and the client ledger. The checkbook shows the overall activity of the account, total deposits and withdrawals. The client ledger shows the breakdown of funds by individual client. For example, if Jessica deposits earnest money from 2 different clients, the checkbook will show the total deposits, but the client ledgers will show exactly how much belongs to each client. This dual recording system is what creates accountability and accuracy. The golden rule: everything must balance. At all times, the total of all client ledger balances must equal the checkbook balance. This is one of the most important concepts in trust account management. For example, if the checkbook shows $1,500 in the account, the combined total of all client ledgers must also equal $1,500. Not more, not less. Another example is when funds are dispersed. If $500 is paid out to a client, both the checkbook and the client ledger must reflect that change immediately. Jessica realized that if these numbers don't match, something is wrong, and it must be fixed immediately. Continuous verification. Catching mistakes. Early trust account systems are designed to provide continuous verification. This means that by regularly checking balances, errors can be caught early before they become bigger problems. For example, if Jessica enters a deposit incorrectly, she can catch the error by comparing the checkbook balance to the client ledger totals. Another example is performing interim checks during the month instead of waiting until the end. This makes it easier to find and correct mistakes. The more frequently records are reviewed, the easier it is to maintain accuracy. Jessica learned that trust account management is not something you check once a month. It's something you monitor consistently. Monthly reconciliation, the final check. In addition to ongoing verification, brokers must perform a full reconciliation at least once a month. This involves comparing 3 things: the checkbook balance, the total of all client ledger balances, and the bank statement. All 3 must match. For example, if the bank statement shows $10,000, the checkbook and client ledgers must also total $10,000, accounting for any outstanding deposits or checks. If they don't match, the discrepancy must be identified and corrected immediately. Jessica realized that reconciliation is the final confirmation that everything has been handled correctly. Handling closed transactions. Once a transaction is complete and all funds have been dispersed, the client ledger for that transaction can be closed. For example, if Jessica completes a sale and all funds have been distributed, that client's ledger balance goes to 0. The ledger can then be moved to the transaction file as part of the audit trail. This creates a clean record showing exactly what happened during that transaction. Property management ledgers, a different approach. Property management trust accounts often involve ongoing balances rather than one-time transactions. For example, rent collections, maintenance expenses, and owner distributions create continuous activity. Because of this, property management ledgers are typically kept active and grouped together for easier tracking and reconciliation. Jessica realized that while the principles are the same, the structure may differ depending on the type of transaction. Computer systems, helpful but not foolproof. Many brokerages use computer systems to manage trust accounts. While these systems can simplify calculations, they still require proper oversight. For example, a system may show a bank reconciliation report, but that report may only confirm that cleared items were entered correctly. It may not show outstanding checks or verify client ledger balances. Another report, often labeled cash balances or something similar, is needed to confirm that the checkbook and client ledgers match. Jessica realized that technology is a tool, not a replacement for understanding the system. Even with software, the broker must ensure that all records are accurate and complete. Real-world example: the $100 error. A broker noticed that the trust account was off by $100. It didn't seem like much, but they knew it had to be corrected. After reviewing the records, they found a simple data entry error. One deposit had been recorded incorrectly. Because they checked regularly, the error was easy to find and fix. If they had waited until the end of the month, that same error could have taken hours to track down, or worse, gone unnoticed. Jessica realized that small errors are inevitable, but catching them quickly is what matters. Bringing it all together. Accuracy is everything. Trust account records are not just about compliance, they are about precision. Every deposit must be recorded, every disbursement must be tracked, every balance must match. There is no room for guessing, estimating, or close enough. Jessica understood that trust account management is one of the most detail-oriented parts of real estate, but also one of the most important. Because in Arizona real estate, the numbers must always tell the truth, and if they don't, it's not just an accounting problem, it's a compliance problem. Online discussion. 1. Why is it important for trust account records to always balance? Answer: because balancing ensures that all client funds are properly accounted for and that there are no discrepancies, which is critical for compliance and protecting client money. 2. What is the biggest risk of failing to regularly review trust account records? Answer: the biggest risk is that errors may go unnoticed, leading to larger discrepancies, compliance violations, and potential disciplinary action. 3. Why must transactions be recorded in both a checkbook and a client ledger? Answer: to provide both an overall account balance and a detailed breakdown of individual client funds, ensuring accuracy and accountability.